Good day, fellow investors. I received this amazing presentation from Sequoia that gives an excellent point of view on what's going on in the market, where are the opportunities, how to take the opportunities and avoid the risks. Of course, they are venture capitalists, they are not really value investing, but we can always learn so much from their perspective because they are the best at this, venture capitalists. And I'll go through this presentation and you'll see a lot of insights into how businesses work, how businesses plan, and what they need to do to survive, to focus in these times that are not that great as those were just 6 months ago. So they'll cover the environment, the public markets, the history, how it teaches us what to do, how to emerge stronger, and how to take advantage of the opportunities. Let's start. I'll slowly pause if you want to pause the video and read in detail what they are presented and what they did, so feel free to do that. And immediately starting with the macro, they are saying how it will be a longer recovery, so we can't predict how long, but they can tell you how to prepare for what's going on. Very interesting presentation, as you'll see. Let's start immediately with the macro environment, and of course this is the key to understand the macro, that all central banks injected incredible amounts of money into the system, and the result is inflation that had to happen eventually, and now it is happening. And of course explaining how the money printing revealed itself in asset prices, and especially in companies beneficiaries of themes like remote work and e-commerce acceleration. And then we had, of course, we all know that, leading to supply chain issues and consequently inflationary trends acceleration, especially with the war and all other. And more importantly, the long-term expectations for inflations as expressed by the bond market are at the highest level in decades. That's very important to understand. So these were the expectations for the forward rate, and you can see how over not even a year we are up 10x, and that is huge. As the Fed pivoted, that was the basis of free money has been hit hard, and it's very important to navigate that. If the Fed continues with its plan to shrink its balance sheet, we have to expect further contracting liquidity in the system that has to then lower inflation but also hit the economy. And the key change is, of course, that capital was free, now it's expensive, and that is a huge game changer also to understand what kind of businesses are you looking to invest in. And of course the worst performing assets were the high flyers of before, the ones that did greatly with free money. Now this has changed. And they say that we are just at the beginning to see how the increasing cost of money flows through the real economy. So just in the first inning, because this takes time to have an effect on the economy, nothing is immediate, and we will just see how this works out over the longer term, which is again something to keep in mind. And as they say, since we are in the early innings of the initial shock flowing through the real economy, backward-looking fundamentals can paint a particularly unreliable picture regarding what's to come. The economy is set to slow, and at this point it's a debate about magnitude. So how big will the hit be and who will survive it? So let's continue with the situation, and of course, third largest Nasdaq drawdown in 20 years as the tech companies got hit. Of course, the Nasdaq was high previously on the pandemic boom, but now it is just a little bit lower, but we will see, and we have to be careful with what is high and what is not high, and that's what they explain. And like you can see, 61% of all the software companies that had a great tailwind the last 2 years are actually trading below 2020 prices. And still, the fundamentals are still great, but you have to wait for the impact over time. And just a comment on the companies still, how they are trading, some of them low. And the shift in the market, of course, now the market isn't rewarding growth at any cost, and now things have changed a little bit the revenue multiples, the growth multiples. The market is more conservative and looking for more value, we can say. Hence they say growth at all costs is no longer being rewarded. And this is an amazing chart to show how sooner or later the exuberance has to end. And that's always what many investors get caught in, thinking that, okay, at the end of 2021, Sven, this time is different, and as much as I can repeat it, it's never different. Sooner or later, the environment changes, and all those who have been swimming naked get hit. And you can see the companies from the Morgan Stanley Unprofitable Tech Index being down 64%, more than double than what the Nasdaq is. And with the cost of capital rising, the market is signaling a strong preference for companies who can generate cash. Welcome to value investing again. Capital is not coming to the rescue, which means that refinancing, more money, more investments cost simply much more, especially in equity debt. Thus, these companies are getting riskier as time goes. And you can see here from the IPO how revenue growth was correlated with the stock price, and we will see now how will this change, because some of these guys will survive, some will not survive, so you have to be careful in picking the one that fits your risk-reward appetite. And they say that durable growth is always the path, but you need to have a good business model, good margins, improving cash flows, as those companies that did well over time have been doing. So constantly improving cash flows, and that might not translate into your valuation overnight, but over the medium and long term, disciplined, durable growth is always rewarded and translates into meaningful value appreciation. Of course, it also depends on the price you are paying. What history tells us? So the pain comes from too much stimulus, too much money, inflation, war, supply chain issues, QE, inflation, and it all creates an interesting situation. And the only way to stop inflation is to stop purchasing, less money to buy, and that consequently leads to more pain. So you have pain or one side or the other, no matter how you put it. They estimate that the recovery will be, unfortunately, long, because you cannot undo all the things that have been done that quickly, without pain, of course. And the key for investing is to see who survives. And as they say, it's not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change. Many of the companies will simply end up very, very badly because they will not adjust to change, and they will just keep on pushing on that growth. And this is a very interesting chart to see, okay, who is going to cut, focus on margin, focus on surviving. Some people will just keep on pushing for that growth to please Wall Street, or because they have been doing it for the last 10 years. But those who are smart, those usually survive. Conservativeness always on top. So then they discuss very interesting strategic positions. What have you done? What do you plan to do? When you have just 6 months left of cash, focus becomes incredible. So get that focus now regardless of how much you have in the bank. But then also, bad times are the best times to invest and to take advantage of opportunities. Embrace reality, adapt quickly, pain of discipline, pain of regret. So keep that in mind and try to emerge stronger. How to emerge stronger? So what do you do? How do you focus? So impossible to predict the future, but you must know what to expect going forward. Be prepared, of course. How to prepare? They have created this framework that helped them in the past. So mind, team, company, just be ready for ugly. And that's also what I also say to investors. Just be ready, and then everything is much, much easier. So I'll just quickly go over these. You can pause this if you want to read into the details. Confront your fear, courage over fear, crisis also equals opportunity. And then again, start with why, how to do it, align your team, ask for commitment, prepare the team. This is mostly for the companies that they have invested in, but it's an interesting insight into how to do business, and you might wonder whether your investments are also doing the same when it comes to doing business long term. Of course, cash flow, and then margins, and something that allows you to survive over time. Then they go into the examples that they have, how those worked over time. If necessary, of course, raise equity, take debt, even if it is expensive. So that's always something that you have to keep in mind. That dilutes you as an investor, but it is how it is. Survival is first. And here you have a great Airbnb example. What was the problem and how they tackled it over time, and how they also tried to work forward. This was the plan for Airbnb, and of course you have to see how the company is changing, which is a very, very difficult investment environment, especially for us. So we cannot take the risks that venture capitalists take, but it's always good to see how they think and how they cope with adversities that will definitely come, and we have to be ready to cope with those adversities, whether those come or not. So if the world outside your company is changing faster than the world inside your company, the end is near. Of course, communicate convictions, confidence, calmness, and just do the best you can do, and all should be okay, but manage the risks, focus on the cash flows, and that's how it goes. The strategy is here for uncertain times. If it's not one of these, it's fluff. Drives revenue growth, saves money, and reduces risk. So even Sequoia is all about value investing, minimizing risk for greatest reward. So it's always the same when it comes to investing. And then they discuss more details about the types of leadership, so you can take a read if you wish. And I really, really enjoyed the presentation. So they are discussing this, but not as a beacon of gloom. They think now is the time to build something truly remarkable. So how many best companies did it in the past? It's up to you also what you will do with your portfolio and how you're going to build it over these times. Most people quit at the wrong moment in time, and therefore they don't have a great long-term investing track record. Thanks for watching. I really hope you enjoyed this. Let me know in the comments what you think. I'll also make a Goldman Sachs market overview, which is very, very interesting. Thanks, and I'll speak to you in the next video.